toutes et à tous. J'aimerais commencer par remercier Finance Montréal pour l'occasion de discuter des sujets tellement importants pour nous ici à Montréal, ma ville natale et que je suis heureux de retrouver après plusieurs décennies, et une métropole profondément engagée en matière de développement durable. I learned this week that Montreal has ascended to be the fourth-ranked city in the world for sustainable finance. And thank you to Finance Montreal for your leadership with the Sustainable Finance Summit and for fostering these 3 excellent days of dialogue. Your growing role in sustainable finance is perhaps best illustrated by your ability to pull together an incredible array over the last 3 days of global investors, of policymakers, and development finance leaders. This moment is also about Canada's growing role in sustainable development finance. During Canada's last G7 presidency in 2018, just 7 years ago, FinDev Canada, Canada's bilateral development finance institution, supporting development through the private sector in emerging markets and developing economies, and the Investor Leadership Network, now comprising 13 global institutional investors, including Canada's own Maple 8, and collectively managing over $10 trillion in assets, were both newly established, born out of a vision to bridge public and private finance for global sustainable development. As we look ahead to the G7 Leaders Summit in Kananaskis this June, under Canada's 2025 presidency, we can say confidently that both FinDev Canada and the ILN have evolved into credible and influential players in sustainable finance. As has been shared during these past 3 days, in emerging markets and developing economies, there is a $4 trillion mountain to climb annually to achieve the Sustainable Development Goals, and about half of that investment gap is related to infrastructure investment. And mobilizing private investment for the SDGs, including for infrastructure, is critical. As we know, public budgets alone are simply not sufficient to close that enormous infrastructure gap. And in response, we are acting with urgency to shape a private capital mobilization agenda that pushes for collective action across institutional investors and bilateral development finance institutions. This year's summit and the G7 DFI work that FinDev Canada is leading is an opportunity to build on that foundation. We see that already with the creation of the G7 Infrastructure Investment Advisory Council, designed to deepen collaboration amongst investors and the G7 DFIs to mobilize greater levels of private co-investment into emerging market infrastructure. It's a strategic step forward in closing the investment gap and a powerful symbol of how collaboration between public and private can have scalable impact. However, this is but one element of a broader solution set. Private investment has multiple channels, direct and indirect, and capital markets, international and domestic, are important channels to mobilize private capital at the scale needed in emerging markets and developing economies. In addition to supporting direct private investment, FinDev Canada is pleased to support capital markets, including through Banco Nacional de Costa Rica, with the country's first social bond, supporting access to finance for micro, small, and medium-sized enterprises, the backbone of economic growth in the country, with at least 40% of the use of proceeds dedicated to financing women-led MSMEs. And a blue bond by Ecuador's Banco Bolivariano, contributing to ocean preservation, water and wastewater management, as well as solid waste management. And Banco de Bogotá's issuance of Colombia's first sustainable subordinated bond, supporting both green and social investments. The Infrastructure Investment Advisory Council that I mentioned and thematic bond issuances are 2 examples of FinDev Canada's innovations to mobilize private capital as we continue to climb that $4 trillion sustainable finance mountain with vigor. However, we are not the only development finance innovators or mountain climbers, of course, and to that end, I'm more than delighted to introduce Jorge Familiar, Vice President and Treasurer of the World Bank Group. Jorge oversees annual funding of more than $60 billion through World Bank bond issuances, and he'll share with us more about the World Bank's work in sustainable finance to support development in emerging markets and developing economies, including their latest financial innovations and instruments. Jorge, thank you for being here. Merci, and welcome to the stage.
Thank you so much, Lori. Thank you so much. And good morning, everyone. It is great for me to be here this morning and to share with you some of the most recent things that we are doing in sustainable finance at the World Bank. But let me, I hope that most of you know what the World Bank is. We are this, institution that has been around for a few years, created after the Second World War, and our mission is to eradicate poverty, to promote prosperity, shared prosperity, and to do so in a sustainable way. That is what the World Bank is. And as you can imagine, throughout our years, we have been present in financial markets, and that gives us a really important comparative advantage. In fact, let me describe the bank in an unconventional way. Let me describe the bank from a financial perspective. I would claim that the World Bank is the most efficient private capital mobilization engine ever created. Since we were created in 1945, we have received from our shareholders $20 billion in paid-in capital. That is all the paid-in capital that we have received. With that, we have gone to financial markets, we have raised $1 trillion, and we have given loans to emerging markets for around $830 billion. This has allowed us to increase our capital base through retained earnings, through reserves that we have been creating, but also to transfer resources to IDA, the International Development Association, which is the World Bank institution that focuses on the poorest countries in the world. It gives grants and it gives concessional loans, very concessional loans to the poorest countries in the world. So if you think about it, this is the equivalent of the countries of the world, coming together and giving the poorest countries $20 billion as a grant and creating this machine out of thin air. So when you think about it, our mission, our AAA rating, which is a very important, let's say, foundation of our financial model, and our experience in financial markets throughout all of these years, the sum of these three things positions us incredibly well for financial innovation and particularly on sustainable finance. And just to give you a few ideas of the things that have come out of the World Bank and our relationship with financial markets. We were counterparty on the very first currency swap in the 80s. We issued the very first global bond. In 2008, we issued the very first green bond. Lori was mentioning a series of blue bonds and sustainable bonds and social bonds. Well, the very first labeled bond was a green bond issued by the World Bank. When we issued that bond, we created a framework to build a bridge between the proceeds we were getting from financial markets and green projects on the other side of our balance sheet. That framework that we created is the framework that today applies to any issuance of labeled bonds around the world. More recent innovations, and also innovations that are not necessarily related to sustainability, but clearly related to the development of global financial markets. We issued the very first blockchain-based bond in 2018, and just a few months ago, we issued a blockchain-based bond. It's a digitally native bond that settles using a token, plus one that settles using a central bank digital currency, in this case, Swiss francs. And going back to sustainability, around 2018, we issued our very first outcome bond, which is one of the innovations that I want to share with you. The outcome bond is a basic World Bank bond, so the principal comes and funds World Bank sustainable development operations. So in that sense, it is a labeled bond. But the coupon, instead of going to investors, it goes to finance another development project, development-related project. The first one we issued, we call it the Rhino Bond, because the coupon went to 2 parks in South Africa and supported a black rhino conservation project. If at the end of the life of the project, which is the end of the life of the bond, we have more black rhinos than a certain number, a donor will come in, will pay the coupon to investors, plus a premium depending on the level of success. If the project is not successful, the investors will lose their coupon because they are running the risk of the development outcome of the project. This was the first one we issued, but then we thought, this requires a donor. Isn't there a more effective way to do a transaction like this one? And we came up with the idea of supporting projects that generate credits, carbon credits, and in one case, plastic credits. So let me describe the latest one we issued. This is a $225 million bond that the coupon goes to a company in Brazil that is buying and leasing land in the Amazon. It's planting native species, and once the native species reach a certain level, carbon credits are created. We have identified and agreed on a buyer for the carbon credits upfront and a certain price upfront, so that the investors are not running the risk. So when the carbon credits are created, this off-taker will buy the credits, and the payout to investors will come from the carbon credits. The third type of bond, which we have not issued yet, but we have a few ideas and a few projects in the pipeline, would be one in which the payout to investors comes from revenue generated by the project supported by the investors in the bond. So these are outcome bonds. The other thing I wanted to share with you, and again, these are things that we are working on, that we are developing, is we just launched a new framework for debt for development swaps. We were not first movers in the debt for development space, but after looking at the transactions that were out there, we decided to come up with a framework that would help make decisions of when a debt for development swap is the right instrument to apply, and also to maximize the amount of resources that actually fund development-related operations. So again, the framework is a decision-making framework, but also the way we are setting up, and we already did our very first transaction in support of Côte d'Ivoire, and this is an operation that supports investments in the education sector. The way it goes is we gave a guarantee to Côte d'Ivoire to secure financing at good terms, and this financing was used to prepay a loan with a discount that would go to support education-related projects. And the way in which we will create trust and confidence that the resources saved will actually go to education and will generate certain outcomes is by taking advantage of the supervision of the World Bank of an education-related loan for Côte d'Ivoire. So this way, the whole of the savings generated by the debt for development swap are going to the development area that is supported by the swap. And this one is being used to education, but it can apply to any other, let's say, activity in the development space. And then another innovation that we're working on right now, the way we, and Lori talked a little bit about this, no? She talked about the importance of infrastructure and the huge gap that exists in the emerging and developing world on the infrastructure space, and particularly in energy, when we're thinking about energy transition and the importance of energy both for development, but the importance of doing it right from a sustainability point of view. And the gap is huge, and we are talking about trillions of dollars that will be needed and will have to be mobilized to these sectors, right? And multilaterals can certainly play a role, but our financing capacity and our financial firepower is not enough to bridge this gap that exists. So the question is, how can we do more? And thinking about it, multilaterals are, like the World Bank, are also very well positioned to take on risks that no one else wants to take. So for example, in an infrastructure project, we are very well positioned to come in early on during construction phase when maybe traditional financial institutions, traditional investors do not feel comfortable coming in. But multilaterals are very well positioned to come in during that phase. Nevertheless, the way we finance operations, the way we finance sustainable development is through long maturity loans at attractive rates. So what happens is, let's say we support a renewable energy project. We come in at the right time. We help turn an idea into a reality, but then we are left with a financial exposure for the next 25 years. When the value add from a development point of view has already materialized. So the question is, isn't there a way in which we could roll off that financial exposure and send it to the private sector, to private financial markets to either refinance or to hold, right? So that we would free up space to move on and support the next project. So this is what we call originate to distribute. And we started thinking about the possibility of securitizing our loans, that is selling our loans directly. And this might very well be something that we will do with respect to loans originated on our private sector side, the International Finance Corporation, which gives loans to private sector companies to execute transactions related with or that generate a positive impact on development. But on the World Bank, on the public sector side, it's a little bit more challenging for a couple of reasons. The first one is we have something called preferred creditor treatment, which pretty much means that countries pay us back first, and they tend to pay us back even when they are unable to pay back other creditors. And this principle is also accepted by bilateral creditors, and it's accepted even by commercial creditors. But this preferred creditor treatment, which is what allows us to grant loans in very good terms to emerging countries and developing countries, is something that we cannot share. It's something that applies to the World Bank, but it does not apply, or it would not apply to a private sector participant buying an exposure from the World Bank. The second challenge is pricing, because again, we don't follow financial norms when we price our loans. In fact, we charge more to countries that have a higher level of development than countries that have a lower level of development. And there tends to be a correlation between the level of development and credit quality. So we charge more to the countries with the best credit quality in our portfolio, and we charge less to the countries with the worst credit quality in our portfolio. So it simply doesn't work in terms of selling those loans to a financial market that is expecting the opposite financial relationship. But we came up with this idea. What if we were to offer a type of loan with a very low interest rate during construction phase for an infrastructure project, and then a step up that would come from something we call the maturity premium? We would cluster the maturity premium, or we would backload the maturity premium to the second phase of the loan in order to create incentives for this loan to be refinanced. And then, so I mentioned securitization as a possibility, and then if you have this structure, there is the possibility of, let's say, refinancing. So if we think, let's say, about a very big piece of infrastructure maybe this could be interesting for a combination of private credit and private equity type intervention. And then the other thing that we have identified as having conversations with financial institutions and financial market participants, there would even be interest in, let's say, sovereign exposures. No? So a country like, I don't know, Indonesia could issue an infrastructure bond and use the proceeds to pay the World Bank back and then free up space to move on and support the next infrastructure project, right? So when we think about these different, let's say, ramps to move exposures originated by the World Bank to financial markets to refinance or to hold, then we can think about changing the nature of our conversations with countries around the world. Because today, the conversations go a little bit like this, right? If we have, let's say, $400 million available to lend to a country during next year, we would sit down with a Minister of Finance and we would discuss, how are these $400 million going to be used? And maybe, the conclusion of the conversation is part of that money is going to finance an education project, part of that money is going to finance health project, and part of that money is going to support one infrastructure piece. So on the infrastructure side of things, we are having conversations which are project by project. If we manage to get, again, an engine going, where resources are available on a continuous basis, the nature of the conversation on the infrastructure side can change to one which is more founded on or based on building a pipeline and making sure that the different projects in that pipeline are correctly prioritized and properly prepared for financial market financing. And if we do that, and if we add a little bit of transparency to that pipeline, we might end up having or creating an infrastructure marketplace, where not only multilaterals will be supporting some of those projects, but I am sure, at some point there will be co-financing, and at some point the private sector will even take on many of those projects on its own. So, these are some of the latest things that we have been working on. This infrastructure marketplace that I have been talking about is something that it's still in the early days. We just let's say signed or are in the process of signing the very first step-up loan, which is part of this project. But this is how things start, right? You start with something small, and then you end up transforming financial markets. When we issued the very first green bond was a $150 million bond that we issued because we identified a group of Swedish investors that were interested in not only in having an investment which was low risk and had a certain level of return, but they also wanted to create a positive impact on the environment. And as we were engaging with those investors, it became evident that we could meet their needs because we had enough projects on the other side of our balance sheet which were consistent with what they wanted to do. We sat down, we thought about it, we built a bridge between the projects and these investors, and we issued the very first green bond, $150 million. Today, we have a $6 trillion labeled bond market out there. And, I would even tell you that few people remember that it was this $150 million bond what enabled all of this financial innovation and all of this impact, positive impact on sustainable development that comes from it. So, thank you so much. I hope that you enjoyed the chat. I know that I dumped a lot on you, but I am going to be around for the next, a couple of hours if you want to continue a chat. Thank you very much.